Carol, the key focus for you is really how important Omicron is going to be to the overall economy. Do you anticipate the Federal Reserve will have to pull back from those 3 rate hikes they signaled in the dot plot?
I think the Fed will definitely use its traditional commentary of being data dependent, and they'll watch to see how Omicron plays out, whether or not we continue to have more rolling closures through here. And keep in mind that Omicron also and the COVID in general continues to impact supply chains as well, especially when you have key places like China argue for zero tolerance and immediate shutdowns with even a few cases in various places. So that impacts global supply chains as well.
Yeah, Carol, I'm still taking a look at the Fed minutes here, and I just want to point out one interesting commentary in here is they talked about sort of how to normalize policy versus how they did it in the past. And they're making it pretty clear here that rate liftoff and balance sheet runoff are going to be a little bit much more in unison than maybe what it was in the past. And I am curious about sort of the pace and timing of not only the normalization of Fed policy, but the idea here that the accommodation that has basically been the norm in our markets for pretty much since the last major recession coming out of 2009, 2010, and of course through the most recent recession, whether this market, I guess, has enough fundamental strength to stand on its own without that full embrace of the Fed that so many people have been used to.
I think the market does, especially as we start rolling into earnings season and we'll start focusing on company commentary and what's going on. Because keep in mind the labor numbers that we've had in the last few days in particular, and we'll get more labor insight later this week. But when you've got jolts where you've got it, when you've got the number of job openings as rampant as they are, and you've quite frankly got a populace that's very sick and tired of work from home and sheltering in place and doing all of that. And so there's a certain amount of endemic demand that's still built into the system. Even though we just made it through Christmas, we suspect that there's a lot of things that people are still itching to do that you'll see roll through, which is supportive of jobs, supportive of a variety of industries that have been very beaten up over the last few years. And by and large, when you look at these companies, large and small, most of them are doing okay, and that economic underpinning should help the economy to stand on its own.
Carol, we take a look at the bond market right now. You're looking at a 2-year yield and a 5-year yield that's up 5 to 6 basis points on the day, pretty much after those meeting minutes. Now just 81 basis points as they're talking about a chance of earlier and faster rate hikes, as the bond market is sort of repricing now at 82 basis points on the 2-year yield what this actually means. What are you looking at when you're seeing this type of rate of change when it comes to yields higher?
Well, it's important to keep in mind the base you're coming off of. So the rate of change is going to be huge because you're coming off of essentially zero or very, very low rates, especially at that short end. And actually, the steepening that we've seen in the yield curve is actually positive and supportive of the fact that it's not just Fed raising at the short end, but you're actually moving things back up towards more normal levels. Because it's important to remember that we're still not back quite to where we were even when the pandemic started. And so we've got a lot of room in that entire yield curve to shift it up a piece. And we've already made some adjustments in wages. Companies are assessing how much adjustment that they can eat internally in terms of their own margins before passing it along, but they've had more pricing power. Companies in general have had more pricing power in the last year than they've had in decades.
Carol, it feels like quite a knee-jerk reaction from the start of this year. Nothing seemingly has changed. Yes, the Fed minutes are once again flagging the chance of earlier, faster rate hikes. But why have you changed in any way the view of how you structure a portfolio, given the sudden move that we've seen in yields, given seemingly the market suddenly digesting really and truly what 3 rate hikes means and what it means for valuations in tech?
Yeah, we really haven't adjusted portfolios at all in the last week or two, and we're not going to necessarily adjust on short-term movements like that. And you did have yields, especially those 10-year yields, were up at 1.617 earlier this year, and then they round tripped as Omicron struck struck and things seemed to slow a bit. There's a lot of factors looking at the market that seem like they're peaking. Supply chain issues seem to be coming off the bubble, if you will, a little bit at the margin. Even though it's going to be sticky for the year, they shouldn't continue to get worse. They should level off in here, as inflation should level off in here in a lot of cases as we get some of this stuff unstuck. So we really haven't changed. We remain overweight equities. We prefer U.S. equities as we have for a long time. We remain underweight fixed income and underweight developed and emerging markets.
Are you concerned at all? Are you concerned at all about some of the volatility that folks are anticipating in this market, Carol?
Well, I think we're prepping people for volatility as we thought we'd see more volatility last year than we did. And it's interesting because you had another record double-digit kind of year, and yet investors' mood is pretty dour over it. The bulk of investors' mood is dour, even though you have some speculative activity at the fringes. But yeah, we definitely think the readjustment and the volatility will increase this year because there's a lot to be dealt with. You do have a leveling off of some things, improvement in some things, and people are going to be watching both the Fed and company earnings starting next week.
Carol, we've been so focused here on the U.S. as we're looking at potentially more hawkish comments, I think, from the Fed meeting minutes than maybe the market was pricing in. You've talked a lot about preferring U.S. equities. How are we thinking, though, about the rest of the world? Because you've had some big outperformance. I think this would be the fourth straight year of U.S. versus everyone else. Can that continue, or are we increasingly looking outside?
It makes it tough, and we haven't gone to zero weight on developed markets or emerging markets. We have gone from overweight early in the year last year to a neutral weight, and then back down to underweight, just based on progress of the disease. We do prefer to stay where we're at there and broaden out our exposure somewhat in other asset classes like extended fixed income. We're looking at real estate. There's some things at the margin, private capital, that is interesting, yet a lot of that liquidity that's been in the global system is obviously flooding valuations across the market. But we still think it's a little too early to tiptoe back in and go towards neutral or overweight those emerging or developed markets. But we're watching closely because you do get to a point where the majority of what's out there is discounted in the valuations.